record. Beautiful. I think if you're able to hear me loud and clear, please just ping me on WhatsApp, ping me in the chat box, please. Thank you. So next 30 minutes, I'm going to talk about an interesting one, where to invest in today's situation. That's what I'm going to talk about. And some of you in this particular call are like me, like in the mid 40s and early 50s, like me. And one of the important goal for each one of us is golden years. During the golden years, what we want to do is we want to have a regular steady income. Today, annuity income is giving you 5%. LIC, if you go to LIC, it's giving you 5%. If you go to a bank fixed deposit, it is giving you something like 5.5%, 6%. Or if you go to an RBI bond, it gives you 7%. If you're in the highest tax bracket, it gives you 7.15, but 30% goes away as taxes. So we are looking for an income, regular income, adjusted for inflation and all that stuff. Healthcare costs are going up. And whatever we are trying to do should also be tax efficient. So all these things put together, I thought we will use next 25, 27 minutes, where we will share what we can do this year, And first things first, whatever I'm going to share is my personal view here with a limited amount of information that I have. So you can't make me responsible. This is a kind of a free webinar, so that I want to let you know. The next thing is we are discussing here a particular strategy, which is going to be very, very relevant in the current context when the Sensex has hit more than 50,000, whereas the Nifty is around 14,800. People are waiting to cross 15,000. Maybe if the budget is going to be a dream budget, it will cross 15,000 next week. And if there's going to be a lot of infrastructure fund, spend is going to happen, or if LIC is going to be kind of coming out for IPO or NSE and all that stuff, we really don't know. Markets can go up to 16,000, 17,000. We never know. Some people are saying the valuations are really high if you use the last trailing 12 months earnings per share. But if you do a forward PE ratio, it's still around 30, 31. The capacity utilization for automotive companies or for manufacturing companies is around 45%, which means without a capex, without increasing the capex, people will be able to generate more revenues. So in this context, where should I put the money and all that stuff? Before that, as part of the registration process, I asked a few questions, if you have any question that needs to be addressed. One question that came up during the meeting is how do you fix the target for a retirement corpus? There is a larger calculation is there. It takes about 30 minutes for me to compute the exact amount. I can clearly say it's going to be 1 crore, 50 lakhs, whatever, or 2 crores, 2.1 crores and all that stuff. I can give you an exact calculation. That will take about 30 minutes. Because you have taken time and then attended the session, I can give this for free for you. You know my mobile number, you know my WhatsApp number, just let me know. Maybe one of the free slots, we will take it. And then I can give you how much money that you need. But those people who are extremely busy, I'll just give you a thumb rule. The thumb rule is, if I'm going to spend, let's say 50,000 rupees per month, then that means in a year, I need about 6 lakhs of rupees. If I want to have a 6 lakhs of rupees, the kind of financial corpus that you need, I'm not talking about real estate, I'm talking about financial asset. The financial asset corpus should be 6 lakhs multiplied by 20 times. So which means 1.2 crores. Is 1.2 crores sufficient for everything? No. Along with that, whatever commitment that you have, for example, business loans, your kids' marriage or kids' son's studies, or for example, medical corpus of 10 lakhs or 20 lakhs, that and all you need to add. So it may come up to 1.8 crores or 2 crores or whatever be that amount. Right? Somebody wanted to know about SAP. Maybe I'll be doing a separate session for 30 minutes on SAP, SWP, and STP. Maybe 15 days from now, I'll do that. The next one is one of my HNA clients asked me Senthil, I don't need the money for next 5 years and the markets are really heated up. Should I go and sell it? Should I go and book the profits? The answer is very, very simple. If the stock that you're going to hold is part of your core portfolio, whether it is TCS or Infosys or Wipro, whatever, or it's a Nifty Bs or whatever, if it's part of your core portfolio, which is a little emotional to you, I will say that no action is required because the Indian economy will grow. Come what may, it may go down, but it will go up. Eventually, it will go up. The next one is if it's part of your satellite portfolio, then you need to book the profits, because the reason is that is in a satellite portfolio, you want to generate higher returns. So that is what I'm going to talk about today. Either how frequently we should be doing the satellite portfolio, how to generate the alpha is what I'm going to talk about, right? So there are two parts to our life. One part to our life is career, running and business and all that stuff, where we spend most of the time at the workplace, and we ignore the families, and health is taken for a toss. That is one part of the life one. Whereas the second part is what where we are right now, where we are talking about retirement. We are talking about spending more time with the family. We want more money, spend time with friends and all that stuff. So that is where I'm going to give you some kind of an option where the fund manager will manage things for us in a more tax efficient way. So that's the interesting part that I'm going to talk about. Please understand, whatever I'm going to discuss about is all investments are subject to market risk. For example, you may think that putting the money in RBL or IDFC is completely safe and secured. Please understand, only up to 5 lakhs, only the capital is secured. Beyond 5 lakhs, there is a capital risk is there. Whereas if you're going to put it in an equity market, yes, capital is at risk. So everything comes up with a risk, except when you lend the money to the government. If you give the money to government of India as way of RBI bonds, or if you go and put the money in post office monthly income scheme or a public provident fund scheme, there things are completely safe. Apart from that, most of the things with whatever we are trying to do, there is a subject to market risk is there. Now, before I go and talk about the solution, what I'll talk about is where we are in the current market scenario. If you have any questions, you can just use the chat box. I will take some questions in between as well. So the current market scenario, if you look at it, the US rates right now is about 0.25 or 0.9 or whatever. That's the rate that has been shown in this particular screen. But I don't think the rates will go up for the next 1, 2, 3 years. Maybe 1 or 2 years, definitely it will not go up. And similarly, when it comes to India, I think the rates may not go up that high. Maybe it could be 50 basis points over a period of next 18 months or so. I don't think they will not increase the interest rates in India as well, which means FD rates will not go up. Whereas the inflation was trading at 7%, but last month the inflation has come down to 4.59%. One thing which is not at all good for most of the countries, including developing countries, is the fiscal deficit. The fiscal deficit is the income minus expenses, like what we try to do. At a country level, all the countries except for 1 or 2 countries, they are all having negative fiscal deficit. The US is leading the pack, right? And if you talk about the earnings per share as compared to Q1 and Q2, the Q3 earnings are going up. And if you look at forward PE, it's doing much better. Maybe in the budget, we don't know what kind of changes that they will bring. In case if they bring few changes, the energy prices may come down. Maybe petroleum prices will come down and things like that. We have to wait. The unemployment percentage is about 6.5 to 7%, but I don't think it is 6.5 to 7. If you look at the unorganized sector, maybe the unemployment ratio is a little high. The US election outcome has played out really well. The liquidity factor is playing out really well. And things are heating up. That's why because of the liquidity and stuff like that and the vaccine and all that stuff, the stock market is doing extremely well. And if you look at GST collections are also going up. Real estate, I'm thinking by next week, there could be some positive news could come from Nirmala Sitharaman. If that happens from our finance minister, maybe market will do extremely well. IBC is something it's called the bankruptcy code. I think we need to wait and watch. Some more companies will be under IBC maybe by next financial year. Then banks will be under strain. So this is the current economic scenario right now. So we can't expect double-digit returns of 10% and 12% or 16% with very little risk is not possible. If you take more risk, it is possible, but little risk, it is very difficult. I don't think the market will run another 30% from here. That means we are at, let's say, 50,000. We can't expect Sensex to touch 65,000 or 70,000 by end of December 2021. I don't think it will be 30 to 40%. It will not run. Now, this is an interesting slide. I attended a session yesterday, and there they presented this particular one, and I really like this pie chart. Especially those people who are very senior people in this particular call, my suggestion is don't build a very huge real estate portfolio. The reason is, especially if you are like building a retirement portfolio, you can have 2 or 3 apartments, absolutely fine. 2 apartments, absolutely fine. One in the city, one in your native place, absolutely fine. Okay. But if you're going to have a huge real estate portfolio, today the children, I'm also dealing with youngsters like at the age of 25, 20, adolescent kids of rich kids and all that stuff. They are all like, they're not able to manage the real estate because like selling a real estate takes a little longer time. So they don't want to see a portfolio where 80% or 90% in retirement portfolio. So if you're building a retirement portfolio, like, build a portfolio with both equity and debt, and try to like, give it to professional fund managers. That's why the pie is really high. And you need to switch between equity and debt depending upon the market scenario. That is the opportunity which I'm going to talk. That means like, a fund manager who can get into debt or a fund manager who can get into equity, depending upon the PE ratio and other price to book, market cap to GDP ratio and all that stuff. That's the opportunity I'm going to talk about. Now, if you talk about mutual funds, is what is one particular way to manage this one. Typically, when you choose an equity fund, what happens is you can put it in index funds, or you can put it in large cap funds, or a mid cap fund, or a small cap fund, and all that stuff. Typically, mid cap and small cap will give you much better returns. Whereas, like, there are funds like, which is investing in blue chip companies or diversified companies, focused funds, and all that stuff. These things are there in equity. And when you talk about debt, you can invest in short-term debt, medium-term debt, ultra short-term, and all that stuff. At the same time, if you want, you can also invest in government bonds, like gilt. It's called gilt securities. Or if you want to lend it to Sundaram Finance, instead of you putting the money in Sundaram Finance or Tamil Nadu Power Finance, you can give the money to a fund manager who will do a credit, like a credit risk based on profile. You will get a slightly a better returns, right? But we had one bad apple, like last year, maybe like one fund house had trouble with 5 or 6 funds actually. Okay. Now, the next interesting thing is, especially for people in this particular call, what I think is that is this one is very, very good, like a hybrid kind of a fund where you want to put money between equity and debt. There are equity saving schemes which talks about only 10% in debt and 90%, sorry, 10% in equity and 90%, 10% in equity and 90% in debt. And there are some fixed allocation funds are there, which is called a hybrid fund where 65 will go to equity, 35 will go to debt, come what may. But I don't believe this kind of funds are not going to do really well in this kind of a market. Maybe where the variable allocation is there, those kind of funds will do extremely well, the variable allocation model. And I'm going to show you some data points. With that data points, you'll be able to appreciate why a variable allocation model is a much better model in a hybrid. That means when the markets are completely expensive, they'll put only 20 to 30% in equity. But like March 2020, like, where both of us, like, didn't make any kind of a call, like, whether to put it in equity or not, the fund manager will take a call and then move a lot of money into equity during March, April, and May. And that delivered 20-25% returns with lower risk. That's very important, with a lower risk. So this variable allocation model is really, really good. Why I'm talking about this is now is, equity market can move in 3 directions. One direction is always going up. I don't think going forward, the market will be always going up. It's not going to be there is what I'm thinking, because it's already had a good run up, right? Maybe what the market will do this year is that is it'll go up to 52,000, it'll come down to 48,000, then it'll go to 50,000, then it'll come down to 46,000, then it'll go to like 53,000, then it'll make. So that means there is going to be a sideways movement, and we don't know how long the sideways movement will be there. But in case of the pandemic, like today I also read in the paper that in South Africa, like we are talking about a newer version of like the COVID. This is coming. If that is going to be there, then if the markets are going, UK had one strain. So if that is going to be there, then the markets will go down. So I don't want to put all the money, like it's a hard-earned money for each one of us, and I'm also going to invest in this particular fund. So I don't want to put all the money where the money goes, like next day. So I don't want to do that. So investing in equity is very, very important. Like when you want to invest in equity, people say that buy low, sell high is what like we all want to do it, but that doesn't happen very frequently. Now there are 3 scenarios are there. Like like as I said in the previous slide, always the market goes up. Like then whether you do a lump sum investment or an SIP investment or an STP investment, or you do a combination of this, you always capture the full swing. That means like everybody is happy. Like the lump sum money is giving you more money because the markets are always going up. The SIP is giving you more money, so you are extremely happy. And lump sum plus SIP is also giving you a good money. Now the next one is downward. If the market goes down by, let's say, 15% down, when I say 15% down, I'm talking about 42,000 or 43,000, like, just like the pre-COVID level. If it goes down, if I do a lump sum in equity and if it goes by 15%, I feel terrible. Like, 15% going away, I feel extremely terrible. But at the same time, if I do an SIP also, it will also go down, but it will help me to do an average of the purchase price. Maybe I can come out quickly, but still I'll feel the pinch. Whereas if I do lump sum plus SIP, the impact is kind of minimized. Okay. The worst thing is if the market is going to move in sideways. When I say sideways, neither here or nor there, then what will happen is even a bank interest, I will not be able to make it like 6% or 5.5% or whatever. If you're a senior citizen, you can get 6%. You can put it in post office monthly income scheme. You can get little 7%, 6.9% and all. But by doing it in this kind of a product, in an equity product, what will happen is there is no real rate of return. So what is the solution for this? If you ask me what is the solution, where to invest in 2021, that's where I'm going to talk about in the next slide. The next slide is like, there is a mutual fund house. There are 44 mutual fund houses in India and which is operating right now. And one of the fund houses is called Prudential America. When you talk about a Prudential America, they are managing about close to something like $1 trillion. When you talk about at a global level. So if you talk about $1 trillion, I'm talking about 73 lakh crores. 73 lakh crores is what they are managing. Indian mutual fund industry is only 30 lakh crores. Okay. Now they are coming up with a balanced advantage fund. And this fund is open till this particular Friday, till January 29th. And I am planning to participate in that. And because I know the fund managers and I've been interacting with them at least 3 times in the last year, I'm talking about in 2020. Aniruddha is the person who's going to manage it. So given this kind of a context, given that they're going to talk about a variable allocation model, and it's called the dynamic asset allocation model, the probability of making better returns, like I want to capture, if the market runs, I need to capture that. If the market goes down, I should not fall same. But in case if the market is going sideways, still I need to get a better returns. So these are the 3 things. So I'm looking at this particular fund, and the next slide is going to be very, very important. This slide. Okay. Now I can invest in like, the competition products, like, whether it is ICICI Balanced Advantage Fund or Sundaram Balanced Advantage Fund or a DSP Balanced Advantage Fund. There are so many fund houses are there, I can invest. But why I need to invest in a new fund offer? NFO is called new fund offer. Why should I look at it? Because they take about 4 to 6 weeks time to build the portfolio. Now this budget, if you talk about budget 2021, there is a probability that budget 2021 will give you an opportunity. The finance minister will think that I've given a great budget, but the market will react negatively. That is possible. For example, 3 years back in January 2018, if you look at January 2018, they brought in something called long-term capital gains at 10%. The market dropped by 6%. Now what happens is if you participate in this fund offer, you get like, the manager is getting 4 weeks to build. So you get 6% more. Effectively, you're getting 6% more. The effectiveness of vaccine is still not known. Like people are getting different kind of results as we do it. And in case of the budget is a dream budget, a lot of people will come for profit booking. If there is going to be a profit booking, still like, you can average it out over a period of 4 to 6 weeks. Even if the market is going to be in a sideways movement, what will happen is they're going to use arbitrage as an option. And they're able to like, deliver little bit like 3 or 4% is what they'll be able to deliver it. Similarly, if you and I are going to do like, this kind of a manual switch between equity to debt, debt to equity and all, it is not tax efficient. Because this fund house is treated as a trust, mutual fund is treated as a trust. What happens is if they sell equity and then buy debt and all, there is no short-term capital gains at a fund level, right? So we have looked at the credentials. We have, and today, the interest rates are also very, very small. We don't have that much of an option. So considering all these things, this is really good. There are some people in this call, who are at 40, 45 and all that stuff, 40 years of age. They are also giving you 36 times cover. That means if I'm going to invest, let's say 20,000 rupees per month, or like, let's say 40,000 rupees per month, after 36 months of SIP, they'll give you something like closer to 50 lakhs of term insurance. This term insurance itself is like, it's like an half a month of an EMI or something like that. So that is why, like, after looking at all the factors, I thought, like, this fund is something which we can look at it right now. You will ask me, like, I could have invested in ICICI or a competition product. Now, last time, exactly 1 year before, on 9th March 2020, I had asked investors to invest 10 lakhs, 20 lakhs, 50,000, 1 lakh, and all that stuff into this kind of a new fund offer for Sundaram Balanced Advantage Fund. Now, when the market collapsed in the month of March 22nd, you will see that this also went down, but this went down only by 2-3%. Like, whereas the other funds, like, in the same category, went down by 15%. So this is what is making the whole thing better as compared to others. That is one of the reasons, because the fund house credibility, the fund manager credibility, and the current situation that we are talking about, when the markets are going to collapse or something like that, or if it goes up also, we'll be able to capture it. Now, we talked about 2018 budget, where they talk about long-term capital gains. Now, the market was trading at, like, at a very good peak when I talk about January 15th and all that stuff. January 29th, January also, it went up by 4%. After the election, after the budget came out, like, it started coming down by -6% over a period of 2 to 3 weeks. So you should look at, like, because all these things are driven by sentiments. Whereas you and I, as an investor, what we need to do is we need to participate. We need to give it to a professional fund manager who takes the emotions out, and then who goes and then, like, makes the right call, right? And if you ask me whether they have done the back testing, the next slide is very, very important. The back testing is what they have done. This is called point-to-point returns. If you do a point-to-point returns, what happens is even in a bull market, like, let's assume that the market is going from 50,000 to 60,000 in Sensex. If it goes by 20%, the model will capture at least 80% or 70% of it. It will definitely capture. So that means you're not missing the bull phase, right? At the same time, if it's going to be a bear phase, let's assume that the vaccines are not effective. Let's assume that the earnings per share is not coming. And if the market is going to collapse by 44%, still this will come down only by something like a 10% or something like, or 16%. So which is much better. Or if it comes down by -20%, this will come only by 3%. Even in a flat market, let's assume that the market is going to be always in sideways. Even in a flat market, you will get kind of an FD kind of an returns. So which means that this particular fund, by God's grace, like, they got the SEBI approval at the right point in time. They have launched at the right point in time. So that is the reason why I said, let me do a call in the morning 11 o'clock and evening 9 o'clock. So that some people are from UK and US are attending. So I just thought, like, let me share this presentation for them. The next thing is, when you do a back-to-back testing on an SIP mode, like, for example, there are some investors at 35 and 30 and all. If you are going to do a kind of an SIP, what is important is something called a rolling returns. If you do a rolling returns, what happens is there is more than 75% of the time you will get more than 8%. So today, in today's world, if you get 8% returns, which is slightly better than your public provident fund at 7.1, it is better than your, like, RBI bonds, like, bonds. And if you stay for 5 years, it is more than 86%. This is the back testing data. So that means, like, the model is good, fund manager is good, and all that stuff. And they are also building a portfolio of 30 stocks. Let's assume 30 stocks. They ensure that, like, they don't put all the money. For example, if the market is very expensive, let's say the PE ratio is, let's say, 40. The Nifty PE is, let's say, 40. And they are picking 30 stocks, and that P is, let's say, 25. So when you divide 40 divided by 25, you will get a little bit more than 1.4 times. That means it's above 40%. So if the market is overall heated up, they'll put only 30% in equity. On the other hand, if it's like March 2020 or April 2020, they'll put all the money into the equity. That is why you're able to generate, like, equity kind of a returns. Now, this is also giving you a term insurance also. So I'm going to invest in an SIP mode as well, because when I compute the values of an SIP, this one, I'm talking about, let's say, 20,000 rupees for a 50-year-old. So that means it's like, I'm going to get at least 15 days worth of EMI, like, I'm getting free. So this is also an added benefit, provided you stay in this particular fund, you don't redeem it. That's what is very, very important. Now, who should be investing in this kind of a fund is very, very important. One is today the average lifespan is increasing, especially if you're a teetotaler and you are in from this one, then what happens is our parents lived for 83, 85, beyond that. So that means easily you're going to live for 90 years. If you're going to live for 90 years and today your age is, let's say, 65 or 60 or 70 or whatever, my suggestion is, even if you're in 70 years, this kind of a product you should look for next 20 years. So which means this is really good. On the other hand, if you're a breadwinner, let's assume that you are the breadwinner and both husband and wife are working, I think still you should look at it up to 5% of your net worth. I'm not talking about a huge portfolio. I'm talking about your overall portfolio, including real estate. Including real estate, if your overall portfolio is, let's say, 2 crores, then you should look at least 10 lakhs is what you should be looking at. So this is also, for example, let's say I am at 70, I'm not getting insurance cover and all. What you could do is you can take the kind of you can put your son or daughter as the first person. They will get the cover, the free cover, and you can be anyone or survivor, and you can still pass it on. And if you go for annuity, you're getting only 5%. And I did a back testing. And if I put some lump sum and then if I do an SIP for 10 years, let's say from 50 to 60, and if I'm able to withdraw the same kind of amount, I can get it for 62 years. No real estate project will give you this kind of an amount. For example, I give 40,000 rupees every month for next 10 years. Can I get the same 40,000 for next 62 years? Not possible. Okay. So what I'm trying to say is that is the power of equity. That is the power of moving between equity and debt, this dynamic allocation. At the same time, if you want to give it to a spouse, this also can be used as your kind of a protection plan where she can get 30,000-40,000 rupees per month, this kind of a planning. So this can be used for anybody. So with this, I'm completing my presentation. I want to show only one extra things, and I'll take only 2 minutes for completing my whole thing. If you want to know, if you want to reach out to me, you can reach out to me on my WhatsApp, or you can send me an email. And this is my website, www.avsenthil.com. Now, what I will do is I will just show only one important this one, and then I'll take few questions. Just 1 minute. Let me know. Are you able to see the screen? Are you able to see the screen? Can you please just type it in the chat box? I'm just sharing a screen. Okay. So if you look at it, what happens is that is this particular tool. It's a research tool. What we have done is I've compared dynamic asset allocation funds with investing in Nifty 50, a large cap or a small cap, or a kind of a mid cap and all that stuff. If you look at it, but for people like us, in the age group of 45 to 55 and all, this has given a much better return. For example, on a 5-year basis, it has given you 10%. On a 5-year basis, it has given 12% and all that stuff. That is very good. The most important thing that you should look at it is risk versus return. Now, the risk of investing in mid cap, small cap, and all these things is the risk is very high, which means the standard deviation is extremely high, and you also get a better returns. But in this particular product, you are still able to make something like 30% return, thanks to whatever the market run up and all. Still, you are able to make a better return at a much lower risk. These are existing funds in the same space, DSP, dynamic allocation, and all that stuff. So that is why I say that this kind of a fund at this point in time is really good. Being a new fund offer, you will get it for whatever 10 rupees or whatever is what you will try to do it. And this is another interesting slide. If you look at another interesting slide, you will see the market will drop. For example, small cap has fallen by 6%. Small cap has fallen by 6% in 2019. Mid cap has fallen down by 3%. Whereas if you have invested in balanced advantage fund, it has given you 8% and 10%. So which means that you are not missing. While this is going to give you a better returns in the longer run, but you and I as kind of capital needs to be protected at 8% and 10%. This is a good product to be looked at beyond fixed deposits. So with this, I think I'm able to complete my presentation. I think it's about 30 minutes is what I said. So what I will do is I will ensure that I will unmute you so that you can ask questions if you have any questions. So completed on time, 9:30. So we have another 5-10 minutes for questions. Any questions? Thanks, Raj. Thanks, Senthil, for sharing your valuable inputs. Talk to you soon. Yeah, definitely we'll talk to you. We'll talk, Raj. Any other questions that you have? I think you should be able to unmute. If you're not able to unmute, please ping me.
Yeah, I'm able to.
Yes, Raj.
Yeah. Thanks. I'll catch up later, Senthil.
Yeah, definitely. Like, Monday, Tuesday, we'll catch up over a call, Raj.
Yeah. Yes, sure.
Definitely.
Senthil,
yes, sir.
I have a different question.
Yes,
Okay,
sir.
I have some relatives who are doctors, and they have been after me, to help them with retirement plan. They are about 50.
Yes, sir.
Shall I refer them to you?
Absolutely, sir. Definitely. I mean, there are three sets of people I'm helping them. One is IT professionals. The second one is doctors.
Yeah.
The third one is NRIs. These are the three set of people whom I would like to support in a big way because they are contributing. So definitely you can put.
Both are doctors, so they are quite closely related.
Thanks a lot, sir. Thanks a lot, doctor. Thank you. Thank you, sir.
Of course, I have questions. I will come back to you on that.
Definitely. Some questions are personal questions, so you can always ask me like one-on-one, right?
Yeah. I need one-on-one.
Yeah, sure. Any
That's
other?
pretty good. Well done. I think your slide preparations are always excellent. Yeah.
Thanks, sir. Thank you. Thank you so much. Thank you so much. So I don't want to take 1 hour presentation and all at 9 o'clock. I don't want to go for 1 hour. So I thought I will do this frequently, at least every 2 weeks I'll do something which is very, very relevant.
I was not sure about one thing. I opted for the 11 o'clock, but I'm running an old age home at home, so I couldn't manage to get into the thing. So I was not sure whether I'll be allowed into this. Then I received your mail and thought, okay, it's still open.
Absolutely, sir. Absolutely. And I'm going to put it in YouTube also. It will be a private link will be there. It will not be in public. So those who attended, for example, somebody would have joined 5 minutes later. So for them, I'm going to put it in a YouTube, what are the in terms of documentation, etc., and how long does it take to complete the process? Arup, it should take, just ping me, you take down my number. It's a 98416716778, or I can just ping it 99529643440. So if you want one-on-one, you can call me, definitely. So these are my two numbers. I have two numbers. So you can just take it down. It's very easy, actually. It's very easy to do it.
Is this not part of the standard bank platforms or something like that where the mutual funds will be there? It should be part of that platforms, no?
Can you please repeat the question?
No, Senthil, this is Rangaraj.
Yes, Ranga.
What I am asking is, this should be part of the, if you have Zerodha or something like that, it should be part of that, the NFO offer should be there.
Absolutely fine. Yes. It should be, if you are using Zerodha and all that stuff, it should be part of that, right?
It should be part of that. You just go, no need of documentation.
It should be what should be the, what should be the option, how to do it. See, because Zerodha and all, you don't have the facility to call them, right? So what happens is that is for example, if you make one withdrawal from the particular folio number, you lose the insurance benefit. So there are small, minor aspects you need to apply, Ranga. With that, you should be able to do it.
Sure. Thanks.
Okay. Anything else?
Great. Thanks very much.
Thank you. Thank you so much. It's 35 minutes, so we'll end the call now. Anytime you can call me. Yeah. Thank you. Bye.
Yeah. Thank you, Senthil.
Thank you.